Ajay Tyagi, Head of Equities at UTI AMC, is now joining us to talk more about markets. Ajay, afternoon. Thank you so much for your time. What do you make of the strength in the market? I mean, all the triggers are playing out. A kind of a coalition, but a strong one is in place. Things are looking fine. Volatility is subsided, but market is just failing to give up any gains. Where is the market drawing its strength from? We just saw the SIP number again, a fresh record high. Your thoughts on the environment?
Yeah, hi, good afternoon, Ajay. And I can only start by saying that we too are slightly baffled with what's happening in the market over the last few days. The election result, if anything, wasn't really as per expectations. It was certainly, in a way, the worst case that many pundits would have called out. But post Wednesday, we've seen an amazing strength in the market. Let's talk about the positive factors first. The biggest positive, obviously, is the continuity of the government under Mr. Modi, which basically means that some of the key policies which have got the support of Mr. Modi will continue. So that's a big positive. The negative, obviously, is what the media has been discussing and debating, which is that it's never, too easy to run a coalition government. There will be pulls and pressures from different parties. We'll see how it plays out. The nucleus, which is the BJP, is certainly stronger than what many of the previous coalition governments have witnessed prior to 2014. So that's also incrementally positive. But yes, there would be some accommodation along the way. In this context, markets which were anyway looking expensive even before the election result came out are continuing to remain expensive. So that's the bit which is baffling for us. Economy is in good shape right now, so that's another positive. But we would conjecture that over the coming months and quarters, the market should ideally consolidate, notwithstanding the strength in the economy, purely on account of significantly higher than long-term average valuation. Yeah.
Fair point. Ajay, what should investors do in this kind of a market? Continue the SIPs, of course. But if you are looking forward to deploying big money, should it be spread out? Is it not the right time to allocate big money on the kind of sense of miss out valley kind of a feeling? What would you advise the investor fraternity?
See, Ajay, I would say that investing under any kind of pressure, either the fear of missing out or the fear of pulling out because you feel that the markets will fall down further, is never a good strategy. You started the conversation by talking about SIPs. I would say this is still the best way to go forward in this environment where markets certainly are looking, expensive compared to their own historical averages. Lump sum money should ideally wait. If you do get some corrections along the way, like we saw on the day when the results were out, that's typically the time when you should put some lump sum into play. But other than that, our advice to all kinds of investors would be continue with your SIPs. Yeah.
The most undervalued part of the market or area which is ignored and unloved and still provide good risk reward, and which end of the market appears to be frothy now?
Yeah, that's an interesting one. And things haven't changed at all in the last 3 to 6 months. The most attractive part of the market still remains the private sector banks. For some reason, they seem to be the most unloved, although in terms of two things, their historical track record to keep asset quality under check, to maintain their NIMs and therefore ROAs is not something which has got challenged or compromised in the last couple of years. So from a fundamental perspective, the way they run their banks hasn't changed. The second thing is that you see credit penetration in India is still low. And that has a massive penetration-led growth in the coming years. And therefore, I would say even from a growth perspective, an overall growth perspective, credit growth in India will remain strong. If anything, it's our belief that private sector banks will continue to gain market share, maybe at a slower pace compared to what they did in the previous decade. But the fact remains that incrementally, they would still gain market share, which means that their growth should be slightly higher than the system credit growth. So that's the part of the market which we feel is attractive, is most unloved today, and therefore the valuations are also very favorable. I would say while the overall theme of capex, investments in the economy, and therefore a lot of these industrial names are most loved. But if you have a look at their valuations, then to my mind, many of them are trading at valuations which are extremely unfavorable. I can't recollect the last time when I saw industrials trading at valuations at which certain consumption names, which have more sticky kind of growth outlook, are trading at. So, uh, while people try to draw a parallel between now and the last time when the economy went into a capex cycle, I do want to remind everyone here that the last time we saw a revival in the capex economy, most of these names were trading at single digit to kind of mid-teen valuations. Today, most of these names are trading at valuations higher than 50 times, some of them even higher than 70 times. So yeah, there's a marked difference in terms of the valuations at the starting point. The outlook in terms of growth in this part of the economy is sound, and I agree. But it's the valuations that one has to be cautious about. Yeah.
There's also a sense in the market that going forward, in fact, the first file the Prime Minister has actually signed after taking office is in the agri and rural side, and that is triggering a view that tier 3, tier 4 kind of creditors, irrigation plays, basically tier 3, tier 4 and rural is where the incremental money or the government's attention may go from here on, and hence market is trying to find names there. How would you recommend is the best play to have a foot in the rural and smaller town kind of a demand play, because the traditional plays like two wheelers etc. have already more than doubled in the last 1.5 years.
Sure. So let's break it up into two parts. I think I completely agree with you that given what the election outcomes have been, this government would try to look at areas which, kind of tilted the voters slightly away from them. So they would like to address, pockets of rural India where they think that there has been distress, notwithstanding the fact that the economy has been doing well. Now, to address that, there are many ways. Like you said, maybe have a better push and a heightened push towards affordable housing. That's one area. And there are, as you know, many listed companies in the affordable housing space. When that happens, there would obviously be a second order impact on the cement industry. The demand for cement should go up. The demand for cement anyway appears to be strong because of the real estate cycle, which right now is very strong in the middle of a big upcycle, and also the fact that the government will continue pushing towards road infrastructure and so on. So I think cement could be another area, and valuations within the cement sector are still fair. The other thing which everybody is guessing would be the consumption staple names. More money, one way or the other, in the hands of the mass population at large should trigger mass consumption, and we know that consumption has been a very, very weak part of the economy over the last 2 years now. And this includes both consumer staples, it also includes consumer durables. So hopefully, the consumption should get triggered in the economy, mass consumption should get triggered in the economy. So that's another sector we can look at. Valuations here again are fair. They're not particularly cheap, but they are still fair. Yeah.
What are your thoughts on cement, Ajay? Because cement hasn't done very well, I would say. Some small cap, mid cap names may have done well on hopes of getting bought out, but in general, the space has remained in a broad range. And even I was surprised to look at the cement price. In the last 10 years, are broadly in a very narrow range. They haven't gone anywhere because of overcapacity. Do you see in the next 3-4 years, with increased government focus on infra continuing, that this demand supply mismatch may narrow and hence pricing power may come to this space, and hence their valuation may improve because EBITDA would improve?
Sure. It will be difficult to comment on the pricing bit. Like you said, a lot depends upon demand supply. And I've also noticed over the last couple of decades that, cement is one area where the government feels very uncomfortable when prices start to move up. Cement touches the lives of the ordinary man. It also impacts the IRRs of different projects, whether in road construction or in general infrastructure construction. So I'm not I think I will not be betting on increase in cement prices, but it does appear that capacity utilization of cement players across the country should increase. If real estate cycle continues, I think there will be more and more demand from that quarter. We spoke about affordable housing just now. We spoke about continued push by the government towards infrastructure creation. So all of these factors augur very well for cement demand. And you're right, valuations for better part of the cement sector are still attractive. So this is one area where investors should do a deeper analysis. Yeah.
Ajay, before we let you go, just a quick word on the pharma space. How to approach this space? The say top 5-6 names have done very well in the last 1 year, but the view is that going into US elections, even though US is highly dependent on Indian pharma imports, some of the policies may become protective about their own pharma sector, etc. All of that. So it may impact Indian sector on the stock market side. But the other part is the India dedicated or India focused pharma play, which are showing very good growth but don't come cheap. How should one play the pharma entire pack right now? How are you going about it?
Sure. So, I would say that within pharmaceuticals, there are businesses which are, heavily linked towards the US market. So these are players which predominantly derive their revenues from exports to the US generic market, to European generics. Now, this is a fairly commoditized part of overall pharmaceutical space. So prices here can move viciously. There are years when there is massive price erosion, and therefore, the profit margins of such players get impacted. Over the last 12 months, we've seen fair bit of stability in prices of generics, especially in the US market. That can continue for a few more quarters, but if you track the prices of generics over the last 20 years, you'll realize that they follow a pattern, they follow a cycle. Weak years of pricing are followed by strong years and vice versa. So I will not be too surprised if we see higher price competition in the US generics, leading to margin pressure, and therefore businesses which are dependent on US generics predominantly may also face some pressure down the line. And you spoke about the US elections in any case, which is a factor which may actually lead to softening of pricing on the generic side. The other part of the market is domestic formulations. Now, this is a more secular part of the market. Pricing pressure doesn't hurt here as much. There are certain drugs in the NLEM list where price revision happens every once in a year. This is certainly a more secular growth story with better pricing power. As you rightly said, valuations here seem to be certainly higher than averages, but they are not preposterous, so to speak. So, one can still find strong businesses trading at around fair valuations here. The third part of the pharmaceutical story is the CDMO part of the story, which many people are also linking up with China plus one. And there is growing evidence that big pharma globally is getting a nudge from their own governments to diversify, to run their supply chains slightly away from China into multiple other destinations. India has been a strong destination for many of these big pharma companies. Many of the Indian companies have had relationship with these people over the decade. So that's the third growth driver. And we feel that this is the one which is an incremental growth driver for Indian pharma companies, and this too can actually have strong growth outlook into the coming decade. Yeah.
All right, Ajay, we'll let you go on that one. Thanks so much for joining us on the show today.
If you like this video, then like, share and subscribe to ET Now.